Good afternoon, everyone. I'm Howard Penney. I cover the restaurant and consumer staples names for Hedgeye Risk Management, and thank you for joining us this afternoon. On the line with me today via Skype is Jonathan Mays of Restaurant Business Magazine. It's an honor to have him here. He's a very prolific writer in the restaurant space. But please note, there's some slides associated with this presentation as well, and we're going to have an anonymous Q&A session, so you can email qa@hedgeye.com, or I believe there's a comment box underneath the video presentation where you can ask questions as well. But before we get going, I need to go through this wonderful disclaimer. Hedgeye is not a broker-dealer and does not provide investment advice for individuals. This presentation does not constitute an offer to sell or a solicitation of any offer to buy any security. This information is presented without regard to individual investment preferences or risk parameters. It is general and does not constitute specific investment advice. This presentation is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions expressed in this presentation are those of the individual speaking and may not necessarily be those of Hedgeye. For more, including terms of use, please go to hedgeye.com. And with that, Jonathan, welcome. Thank you for joining me today.
Thank you for having me on, Howard.
Good. So I've put together some slides, Jonathan, and what I want to do is just sort of roll through them, and as I roll through them, maybe ask you a few questions, and maybe you can provide some commentary on some of your thoughts. Sure. I have some definite opinions about some of the names that we're going to talk about, which you do know. Anyway, I'm just going to turn to the first slide, which is a cartoon by our great Bill B. Rich. And it is, why isn't, well, so we've titled it, right, why isn't restaurant traffic stronger? As you can see, the consumer confidence is at 18-year high, the unemployment rate is low, wages are growing. So what's your take on restaurant traffic these days, Jonathan?
There are too many of them. So that's the fundamental issue. If you think about it, restaurants have spent the last 10 plus years building new locations, starting new concepts. We've had a ton of money flowing into the sector year after year. Lending is readily available for just about anybody. There are roughly 1 million lenders who are eager to make loans. All of this is sort of kind of generated this feeding frenzy in the restaurant space, where we're adding new locations, developing new concepts, coming up with different ideas, and the thing is, when consumers have a lot of choices, they make them. And that's essentially what's happened. We've had same-store traffic weakness for the last 3 years, and consumers are simply using their wallets to make choices. And any restaurant company that doesn't do its job, even a few of them that do its job well, are struggling to generate same-store traffic.
Yeah. Well, the good news is, as you can see on the next slide, which is slide 4, retail sales for food and serve drinking places, and this is the government data, is showing a surge in spending. So consumers are out there in spending, and I think that, to your point, Jonathan, you know, there are just too many stores, frankly, and there's not enough good ones, to be honest with you. As you alluded to on page 5, you can see the black box data for comparable sales and comparable traffic. And notably, sort of since, and I think, and it's not quite a perfect correlation to this, but you can see a pickup here in November of 17 and into 18 in the restaurant sales or comparable sales, which is partly due to pricing, and to a certain degree, maybe the Trump tax cuts had a certain benefit to some consumers, which may have spent, maybe spending a little bit more in restaurants. And as you've said before, as you've seen before, the previous slide showed retail sales improving, but the traffic, as you can see on the right side, is not doing well. And on slide 6, Jonathan, you can see, so there's a bit of a debate, I think, a little bit, or I'm going to create a debate anyway, between the chains and the independents. And there's a group out there that likes to talk about the supply of independents and whether they're growing or declining, and based on sort of what you just sort of alluded to, the money flowing into the space. I think actually independents are probably growing, frankly. I don't believe they're not, but where do you sort of fall on that? I know you just sort of alluded to there's too many of them, but the debate between the chains and independents, where do you come out on who's winning the battle?
Well, at this particular point, small chains and independents are winning that battle, and that's the only conclusion that you can really draw from the last few months of numbers. Is that as the retail sales data point to a surge in sales, chains haven't kept up, and the only thing, thing you can conclude is that as consumers have felt better over the summer, they've gone out to their local independent, or they've gone to a small concept, and as I said, there are a lot of new and different restaurants out there, and people really want to try them. I think delivery has been a beneficiary. I know you're talking about delivery a little later, but delivery has been a major beneficiary to the independent, probably more so than the chain world. And I don't know, consumers sort of get tired of going to the same places all the time, and they want to try something different.
And delivery is giving them that option. We're definitely going to talk a little bit more about delivery, because we're gonna do a deep dive into delivery in the next couple months. But I'm coming out that for the chains, I think delivery is going to end up being a negative, frankly. But we'll see how that unfolds. But the next topic from a macro perspective that I just want to get to is inflation and wage inflation on slide, I got to put my glasses on to see this, slide 8. And this is one of the more difficult issues that I think the industry is facing today. And there really doesn't seem to be any relief on it. And it's good news and bad news, right? Because you've got wage inflation, right, which is putting money in consumers' pocketbooks, but you've got the pressure on the P&L for a lot of these restaurant companies. They're forcing them to raise price, which is creating, sort of that, premium. It costs more to go out than it is to go to a supermarket. And as you can see on the right side of slide 8, since 2000, wage inflation has run, about 2.7, almost 3%, and now it's running 4%. So from where you sit, Jonathan, how does the industry deal with this issue of, and not only just inflation, but also the supply issue?
The industry has to get more efficient. The fundamental problem with restaurants, today, is that it's a very inefficient method of delivering food to consumers. And if you compare it with C-stores and grocers, which are their two primary competitors for the food dollar, restaurants spend a lot more on labor. Now, of course, it needs to, because it's definitely more of an experience than going to your gas station. But it's just an industry that really needs to improve its efficiency, whether it's through technology, whether it's through a shift in the way that the industry employs people, that sort of thing. It really is absolutely necessary. And one of the challenges of today isn't simply that wage rates are going up. It's that wage rates are going up in an industry sector that spends a third of its revenue on labor. So it has a lot more employees than either a grocery store or a convenience store. So it's getting less from a profit standpoint. It's getting less competitive.
Right. So I went to my local independent restaurant the other night for dinner, and I had to wait 15 minutes. Yet there were, call it 5 tables open. And I went to the hostess and I said, "Why can't I sit at that table?" And she said, "Well, we'd love to have you sit at the table, but we don't have a server to be able to take care of you." so you can't sit there. So there's this other issue of supply, which is putting pressure, I think, not only obviously on wages, but on sales, right? They're not unable to satisfy the demand that's out there for eating out, especially those places that are, have fairly decent eating out. Which brings me to the next slide on restaurants pricing aggressively, and this one is you can see on the right hand side the food at home versus food away from home inflation differential. And the spikes to the top of the chart are good for the restaurant industry, and the spikes to the bottom of the chart are bad for the restaurant industry. And we've certainly seen this issue develop over the last couple of years, where the industry is fighting against the supermarkets, which are much more competitive, not only from a price standpoint and what you could buy and bring home, but just sort of the food they serve, because they're trying to be like a restaurant. I think Kroger a year ago upped its target market in terms of what it wants to serve, not only but not only from the supermarket standpoint, but from the the food at home and food away from home target. So any thoughts on pricing from the industry and this differential?
I think that especially with certain chains, Buffalo Wild Wings, Dunkin', and Starbucks have had challenges along this front where they've raised prices maybe a little bit too aggressively, and over time consumers notice these things. If you're you spent last year you spent $1.50 on your coffee, and now you're spending $2.50. You might be less likely to get that coffee every single day, and that's definitely a problem for many restaurant companies. I think it's been a challenge for Starbucks in particular, because I think that they've had a tendency to lose some of their less loyal customers who are a lot more price sensitive than your more loyal fan base. So yeah, I definitely think it's a challenge in the industry if you're pricing yourself in some cases these companies are pricing themselves out of the market.
Yeah. So this brings me to sort of the hot topic of the year. We're getting closer to talking about the fun stuff, and that's the companies. But I want to talk about delivery for a second. And you can see on slide 10, delivery is changing the restaurant industry. And what we've done here, Jonathan, is pick quotes from different conference calls. And the green boxes are the companies that are going after delivery aggressively, and the two red boxes are the two companies that are not, right? They're taking more of a wait-and-see approach. And Darden and Texas Roadhouse are the two, excuse me, that are taking a wait-and-see approach. And I would, argue that they're probably two of the best-run concepts today, with Olive Garden and Texas Roadhouse, and probably Texas Roadhouse gets the gold star for being the run concept out there with positive traffic in an industry that has negative traffic. One, they don't price, right? So we've just had that discussion where they're very good about not gouging the consumer, a value concept, but they're also taking this wait and see approach to delivery. Now, you can argue and you can think, okay, if these guys are the best operators in the business, they must see something in delivery that they don't like, and they don't, that they don't want to go after it. Now, it's the obvious one is they don't want to pay 25 to 30% or 15% or whatever the number is to the aggregator to get the food delivered. And the other people that are going after it, and I'll just take Applebee's, for instance, and I'll just use them as the poster child, right, of maybe one of the, up until recently, one of the worst chains run. At least they've made some of the biggest mistakes, and maybe the discounting is another mistake, but we're going to have to get through this period of positive comps to figure that one out. So just your take on delivery. I mean, am I being too bearish that I think that this is going to be the end game for casual dining if people want to eat at home versus inside the four walls?
That's a really good question. I don't know it's the end game. You might be a little bit too bearish. And and I think it tends to be more from a casual dining side. It tends to be more of a chain specific element. You know, I just don't know the extent to which that delivery becomes, you know, a huge traffic driver to the industry. I'm highly skeptical that it is fully incremental. And I tend to believe it shifts sales from some occasions to another, or it shifts sales from certain types of concepts, chains to independents. I'm not, you know, I'd like to see the person point out to me a restaurant chain that has gone big into delivery that has traffic growth, because I can't think of one. So I'm, you know, I'm a little bit agnostic. It's definitely something that there's definitely demand there. There's definitely people who are really interested in getting delivery. It definitely has its uses for a large number of people, but we're still talking about a small percentage of traffic, and I'm just not really sure. Sure, it's growing by leaps and bounds, but it's growing off of a very small percentage. So I don't really believe it's the end of casual dining. I think the bigger challenge for casual dining is the takeout overall, where people just want to go pick up their food and take it home with them. And, you know, delivery is part of it, but the bigger issue is just people want to get their food and go. And casual diners that can figure that out are going to succeed. But at the same time, you know, Applebee's wasn't built for the to-go business. Chili's wasn't built for a to-go business. Olive Garden really wasn't built to handle a lot of to-go traffic. They're not located in those areas. They don't really have the layouts built for consumers coming in and getting their food and taking it with them. That's the fundamental challenge. People just don't eat inside restaurants anymore. That's the bigger overall challenge than just delivery. Delivery definitely plays a role, and definitely a lot of people. I know an operator who will tell you that he sees people passing by his restaurant, they go home and then they order delivery from his restaurant. Yeah. So it's just you know, it's definitely an interesting trend. You know, how big this ultimately is, you know, it still remains to be seen.
Yeah. So not that the market is correct, right? But the market is telling us to a certain degree, with Grubhub at $140 or wherever it's trading today and a $13-14 billion valuation, that there's going to be a big shift to delivery, frankly. And you know, you have private companies talking about it, and even some public companies talking about 20% of industry sales going towards delivery. And you know, if you've got two things there. One, if 20% of your sales go towards delivery and you're having to pay 15% fee, that's a problem. And then the second thing is on slide 11, you know, who's responsible when there are issues for delivery? And we don't have to talk too much about this one because this is yet to be seen, but you know, the restaurant, it's really going to be tough, and I think for a lot of the restaurant industry that, you know, is putting their brand in the hands of a, you know, third party, there's certainly some risk that goes on with both the brand and the consumer, and I just don't think the consumer is going to give the brand a pass, frankly, for cold French fries or a cold burger. You know, I don't think they're quickly going to put it on the delivery service. But to your point on the next slide, on slide 12, Jonathan, is where the incrementality is coming from. And, you know, this survey is showing, you know, it's coming from an at-home meal. And it's, you know, the evidence is, you know, it's early. This is an early survey. We don't really know where it's coming from, but there certainly is, you know, a lot to be said for where delivery is going and what the market is implying. And frankly, there are hundreds of millions of dollars that are being, you know, pumped into these private companies, DoorDash, you know, and others to drive this space further. So, we'll have to see where this goes. But anyway, so let's have some fun with some names, if you don't mind, Jonathan, because this is what I love to talk about. So let me just start with this before I get into McDonald's. So the top performing stocks so far in year to date are Noodles, BJ's, Habit. So Noodles is up 123%. BJ's is up 100% this year, right? Incredible. Habit up 73, Wing up 70, and Chipotle up 68%. What do you read into those stocks doing well this year?
Bandwagon. Noodles. I like a lot of what they've done. Their zucchini noodles is really one of the best products we've seen this year in the restaurant space. Fairly big deal for them. A lot of this is sort of performance. I mean, BJ's was, I was convinced for a long time that somebody was going to snap up BJ's and buy them. And then they've seemed to have turned around. They've generated some strong sales growth. That's a company that's really done a good job in sort of addressing this delivery issue. They've done beer and wine delivery, which is kind of a key element for a company that really needs beverages to generate a profit. From an individual perspective, I think there's a lot of enthusiasm for Chipotle right now. I'm not entirely sure why there's this level of enthusiasm for them, but
bacon's not going to save them, Jonathan.
Yeah, my thing is the bacon is bacon is great. Love it. It's good. I don't have a problem with bacon specifically, but how, to what extent, at what point do they sort of cross the line, and kind of damage what it did to Chipotle? So one of the things that had driven Chipotle so well for so long was that they were, and one of the concerns I have, to a certain extent, I don't know how big of a concern it is, but one is that they're just doing so many things that traditional fast food, and bacon just plays a part of it. That are they Chipotle? That's
yeah. So, all right, so I want to switch to, we're going to go through McDonald's, Starbucks, and then a few others. But so on slide 14, I have McDonald's same-store sales, global same-store sales going back to the first quarter of 10 through the second quarter of 19. And you can see the pickup in sales in the third quarter of 15. Now, remember, Easterbrook came in, I think, a few months before that, late 14, I think, early 15. And then he simplified things. If you flip to the next slide, simplified things in 15, so you can see the menu size goes from 108 to 72. And now the menu size is going back up again. Now, I'm all for simplifications in the restaurant industry and not complexity. And then the next slide you can see on slide 16, they've gotten, so the promotions went down, right, from 2013 to 2015. Now the promotions are going back up. So promotions going up, menu items going back up. Drive times, the drive-through times are going down as well, which 70% of the business goes through their drive-through. So, and then the last slide of McDonald's, and I'm making my bear case argument here for Jonathan, and you don't have to, you can confirm or deny, or you can not say anything. But so there's complexity. So my saying is growth creates complexity, and complexity is the silent killer of growth. So why are all these things that McDonald's is doing, including technology, going to accelerate sales and not decelerate sales? Or why is this good news for McDonald's, not bad news? You don't have to have an opinion if you don't want to either.
Oh, on balance, I mean, I like a lot of what they've done, on an individual level. So, finding ways to add technology into a restaurant, if you can use that to improve your efficiency, which theoretically your kiosk do down the line, right? That's a good thing. Using the tools that you have available to you to try to improve your business is a good thing. Fresh beef, improving your core product should be a good thing. If you're, the taste of the quarter pounder is much better today than it was before they did that. And then adding delivery theoretically should generate incremental sales, which, if it is, it should be drawing more people to your restaurant because you're giving people more ordering options. All of these things, put together should really point to a McDonald's that has a better experience, is giving consumers better tasting food, and it's giving them more ordering options. But man, it's a lot at the same time, and you're asking your franchisees to do an awful lot. And I think that's the issue of the complexity that you're talking about. Is the danger to me has not been what are these individual things they're doing, but that they're doing them all at the same time, and that's an issue to me, and that's where the complexity comes into play.
Yeah. So two things on that. One, I agree with you, and I think the technology that McDonald's is putting into their stores, the kiosks, there's an intended consequence from that, and that is because they want to reduce labor over time. So they want to shift the consumer's behavior when they walk into McDonald's from ordering from a person to ordering from a kiosk. Now that will take years to happen, but I think that's the intended consequence because they can't afford to pay that person $15 in wages. So the CEO of McDonald's will never say that publicly for obvious reasons, but I think that's the intended consequence. That's Howard Penney's intended consequence of what McDonald's is doing anyway.
I fundamentally agree. I think that I don't see any reason to do it long term unless you think that over time this is going to give you the ability to make your operations more efficient and improve your labor costs. I think long term, that should be a definite benefit, and I think that's why. I mean, it's not just McDonald's doing kiosks. You're seeing a number of companies that are really looking into this. Kiosks are pretty major.
Yeah. So complexity is a theme that I'm going to stick with, and I'm going to shift to Starbucks. So on slide 19, you see the Americas same-store sales, and I'm picking the Americas same-store sales here for Starbucks because I think that's the more relevant to the story, anyway, the story of the stock performance. But obviously, from the first quarter of 12 doing a 9 to the third quarter of 18 doing a 1. And this is another complexity story as their times have gone down, their ticket times have gone down, they're serving food, they're doing all these, trying to sell more to their consumers. And on slide 20, this is a similar sort of story, if you will, with McDonald's. If you look at the menu trends for Starbucks, so the total menu items are up a lot, which again, if you want to correlate that with same-store sales and promotions, menu items go up, sales go down, and on the next slide, slide 21, menu items go up, sales go down, and on the slide 22, this is my Howard Schultz slide, if you will, where he came back at a time when Starbucks was struggling after he left, and then the company cut capital spending because they had to slow growth because they were growing too fast, and then he left at the peak of capital spending again as sales were slowing. So and for whatever reason, he decided to leave today. He decided to leave this day, and he left the ship drifting along, if you will, with a CEO that doesn't look like he's ready to take the right steps to fix the sales trend. So I don't know if you have any thoughts on Starbucks, but I'd love to hear them.
I think they might need to slow down again, right?
Yeah.
They've added, they're adding units at a pretty rapid pace. They just overtook McDonald's as the second most unit-heavy restaurant chain in the U.S. That unit count tends to be concentrated in very specific markets. It's not spread out. It's really heavily concentrated. So I think that's one of their issues. I think complexity is definitely a concern. And as you saw on one of your previous slides, you noted the drive, and McDonald's was fairly slow. Starbucks was slower, and I like Starbucks, and I'm a heavy coffee drinker. But I see a long drive-through line. Boy, I don't want to go through it, and that's definitely an issue for somebody like them. And I think the issue with McDonald's and Starbucks fundamentally is and we go back to this issue. Really, one of the penultimate issues right now is this takeout trend. People want to take their food with them, and the better the job that you can do to help people take their food or drinks with them, the better you're going to do.
Yeah.
And that's kind of that's a pretty major issue, and so I would agree with you on the complexity that it's hurting their it's hurting their service times, and it's making them and I think it's hurting their traffic.
So I'd like to shift to a few more. I put in here some same-store sales charts for a couple of names that I think are pretty topical today. We've already talked about Chipotle. I love Chipotle today. I think we're doing a deck next week on Chipotle called Chipotle is the next Chipotle. And sure. I think there's a huge opportunity here, but we'll see how that unfolds. We sort of talked about that. So Dave & Buster's, another one that I'm not too bearish on. I've witnessed this company go under down the tubes once before, and I think I'm witnessing it again. But can virtual reality save Chipotle? Save Dave & Buster's?
Shouldn't they improve their food?
Crazy, right? To serve good food, that's kind of insane.
That's just I don't know. I have an interesting theory on them, because their numbers, if you look at their sales numbers, actually kind of echo one of their primary rivals, which is Chuck E. Cheese, and I think that one of the things that have hurt them is the popularity of games like Fortnite. This is in Fortnite sort of came onto the scene last year, has become very popular with a lot of Dave & Buster's core market, and so I don't know that virtual reality can save them. It really hasn't been. I just don't think that we've seen that popularity of that overall sector of the gaming world take off. I think it's just not. I mean, look, the fundamental Dave & Buster's business, frankly, is great. The games are super profitable, and it's they definitely have a lot of benefit. But I'm just not really all that bullish on the ability of virtual reality. I don't see it as. I mean, I'm not a gaming expert, but I haven't really seen anything where consumers are just like rushing out to buy these virtual reality headsets. It really hasn't quite taken off. Right. At least that's my perception.
So if you go back to that chart on 24, if you look at the, to your comment, Jonathan, about the food. So the food was an leading indicator. If you look at the decline in food sales, was a leading indicator to where the games business was going. And the reality of it is, the food is not recovering, and even the most bullish analysts, and these are the estimates from the bullish analysts, right? So they don't have food recovering, but they have the games recovering, which is kind of an interesting dynamic, and I don't know how that's going to unfold. All right, so Cheesecake Factory, this is one where it's just, so you live and die by your, people coming in to your stores, and this is, they manage their business by raising price. They've had 4 years of declining traffic, and what you're seeing here is Cheesecake Factory same-store sales and essentially all price. So any thoughts on malls or Cheesecake, or can they survive the delivery onslaught?
Well, they shouldn't they? I mean, they're they're definitely experiential. I mean, they're doing stuff on delivery. They've been relatively aggressive on that front, especially compared with their primary rivals. But I don't know. The malls are sort of a challenged business right now. It's kind of I don't know. I think that cheesecake has a lot going for it. The cheesecake, for one thing, it's still very popular. Those stores make a ton of money per location. The fact that they've raised prices to the length that they've done, to the extent that they've done, and they're still generating sales growth, is in a kind of a benefit for them. I mean, I definitely like to see them get crap.
Domino's. Domino's, an extraordinary company, frankly, just something I've never witnessed and I've missed, frankly, and I've been wrong on trying to call the downturn on Domino's. So I've tried to argue that the aggregators would ultimately hurt Domino's in terms of, the delivery and the options that consumers have now for choice, right? Instead of you give $20 to the babysitter, right? And instead of saying order Domino's, you can now get McDonald's or something else. And so unsuccessfully, it hasn't happened. Patrick Doyle's leaving, probably one of the most successful CEOs in the industry. Any thoughts? Domino's, will it end? Go on forever?
Well, I mean, they're not going to do 10% a year. No, I mean, it depends on where you sort of establish the goal line. I mean, nobody grows forever, and at some point every chain has to go through a downturn. When that happens with Domino's, I don't know. One of the things, a couple of the challenges, that there is that delivery business out there, it's hard to look down the line and not wonder whether that does take away some business from the pizza chains. The other thing with Domino's is their unit volumes are fairly high for their business. I mean, it's over 1 million, far higher than any of its rivals right now. And, again, at some point, you just can't keep that up over time. At some point, you're going to come down. You're going to have a negative number. You're going to slow. But man, who else is there in the pizza space right now, in the major pizza space? That's the thing. I mean, Papa John's is a mess. Little Caesars is that's a strong competitor, and they're not public, but they shouldn't be overlooked. I think Pizza Hut has definitely a lot of potential, but they still have to work their way through some things. They have still offering store.
Yeah.
But and then Domino's is right. I mean, their stores look really good. Their technology is off the charts. Nobody.
Yep. So,
It's such a strong company. I would have never. When you say that you miss down everybody else, nobody.
yeah. So, your comment about everybody goes through a downturn is great for our last company I want to talk about. But one final thought about Domino's. If you look at their overseas businesses, yes, the U.S. business is extremely strong, but there are a few chinks in the armor when you look at the other two publicly traded Domino's businesses. And so before, there's a couple questions that I think we covered some of the questions in talking about the names. But so you've written more about Papa John's than I think anybody on the planet. And probably know more about what's going on at Papa John's on the planet. And it's the chart, you can see they have some problems on slide 27. They have a few issues. And not only are consumers not going to Papa John's as often, or ordering Papa John's as much as they are, but now you've got a feud between the CEO, old CEO, and the new CEO, or the company and the old founder name on the door, however you want to refer it, and they're airing their dirty laundry in public, which is extraordinary. I've frankly never seen anything like this in my 20-some-odd years experience following this industry, or anywhere, frankly, in any industry. So, can they recover? Yes, we know they can recover, right? Domino's was a disaster years ago. It is a hero now. McDonald's has failed. Starbucks has failed. Domino's was a disaster. I mean, Dunkin' was a disaster. So we know they can fail. But if you have if your vision for how they crawl out of this hole, how do you see it playing out, and how do you vision their resurgence?
Well, they need to get this thing past them like as soon as possible, right? I mean, you know, the thing is that there's still some, you know, there's this other shoe to drop with that independent investigation of the company's culture. That stuff is still out there. Absent the John Schnatter stuff, that in and of itself is a concern in probably the short term about what happens with them. I'm beyond that. I really don't know. I mean, you know, really the best thing that could happen for them right now would be some sort of buyout where they can go private. They get this stuff past them. They figure out their, you know, their next ad strategy. I mean, I like a lot of what the company is doing. They're, you know, they're putting money towards their franchisee base. That's really important. They're developing a new ad campaign, and you know, they do have some very fundamental strengths. It's a very good thing to be the quality provider in any business. And so they still have that. They haven't lost it. But you know, the fact that this issue is still going on, that they're not able to get past it is a significant problem. And I don't know, you know, I mean, without John Schnatter's sort of approval, I don't know how they get taken private in any fashion. You know, so I'm kind of stumped on this one. This one really, I've never, like you said, I've never seen anything like it.
Yeah, and it's not good news if Wendy's. It's not good news for Wendy's if they buy it, frankly. But that's my. All right, so Jonathan, thank you. I'm just going to run. We for 45 minutes. I don't want to go over an hour. So the next 15 minutes, we're going to run through our version of the lightning round, if you will. Okay.
Sure.
4 names. So, Red Robin.
Yeah, you know, that's a good one. You know, they've, you know, that's one. that's another one where I'm a little bit stumped. I think that they probably were almost too honest in their last, when they came out with, when they came out with their pre-announcement. It's a casual dining name. This is fundamentally, this is kind of a problem. If you're getting growth at one bar and grill name, you're almost invariably going to get weakness in another. And we've had relative strength at Chili's. We've had some fairly nice comebacks so far at Applebee's, and then we see, and then BJ's is another name that has done fairly well. And so, so Red Robin has lost some customers. That's one where it's another one that I kind of scratch my head a little bit and try to figure out, where do they go from here?
I think that's.
Yeah.
All right, two more casual dining. Well, let's go. We'll do Del Frisco's first.
Yeah, I love what they bought. No question about it. I think anything that really gets me very excited about Del Frisco's, it's the acquisition of Barteca. That's a real highly regarded name in the business. But
did they pay too much for it? Is kind of the question that people are wondering, I think. What about Brinker? What do you think about Brinker these days? Casual dining, Applebee's, same kind of issues?
I still say that, the bar and grill sector has long-term concerns. Right. I'm definitely not on board with the idea that they fully come back. It's still relatively overstored. There's still a lot of different providers. I mean, look, casual dining has added locations almost every single year, between 2010 and 2016, at a time when their traffic was declining almost every single year. So there really hasn't been enough reconciliation between demand and supply. So I still have longer term concerns. I tend to be a little bit more on the bandwagon of what Chili's did than what Applebee's is doing. Getting people, like Applebee's getting people in the door because, for drinks is generally a good thing, reminding consumers why they liked Applebee's in the first place. But, simplifying your menu, getting back to the issue of complexity, Chili's really simplified their menu quite a bit. That really should help with throughput and be more of a longer term benefit. They're not getting the rapid spike, which is being brought about in part by easy comparisons. But they're so I tend to be a little bit more bullish on them long term, but I still really need to see some overall reconciliation in casual dining supply.
Right. It's not going to end well for Applebee's, and Chili's has sustainability with you. I agree with that. So I think we elaborated on the bearish stance on McDonald's. We talked about Domino's. Suppliers, I don't know if you have a view. I know I have a view of the suppliers to the restaurant industry, like U.S. Foods and Cisco.
What's your view on the suppliers? That's what
They're all shorts, frankly. But CMG, we talked about. Grub, I think it's, if the industry's going to 20% of sales in delivery, Grub's going to double from here, I think, probably.
Yeah, they're one of the better, and they're definitely one of the better providers. I mean, that the delivery business is definitely shaking out, and you definitely are seeing some absolute winners. Those guys, DoorDash, I think Uber Eats. So you do definitely see some kind of a reconciliation of that overall business. While I do have some general questions about the impact of delivery on the restaurant space, I definitely think that delivery as a business is going to continue to grow because consumers obviously like it, and anytime you can improve. Anytime that you can improve consumers' ability to take food with them, I think is generally a good thing, because that's where people
Yeah. So I think we covered Dines, Chipotle again. We're going to talk more about Chipotle in a week. Upcoming catalyst for Starbucks. They're going to miss the numbers. The last question here, Jonathan, again, thank you for doing this. I really appreciate it. It's been a lot of fun. If you had to pick who is the best CEO in the restaurant business, if you can do that, I don't know if you can be so specific but who's the best CEO in the business?
Oh. Well, you know,
how about a top three? Top three.
Well, I mean, you got to put Gene Lee there. You know, I got to remember when he took over, you just thought that Olive Garden was losing all his customers because they weren't going out to eat anymore, and you know, really, he's done a
great job. Yeah.
I mean, I have concerns about Cheddar's, but on balance, what they've done over there has been pretty strong. So you definitely have to put him there. I mean, just, you know, a couple of names. I like John Miller at Denny's. You know, that was a name that was like dead when he took over. You've got to give him a lot of credit. You know, I still like what Steve Easterbrook has done at McDonald's. And I mean, again, we have some concerns about complexity in the United States, but that's a tough ship to steer. Yeah. And you know, and he's done a lot of very, very good things, without question. Really generated some real enthusiasm for that particular business, and you know, it's really good. You know, I don't know. There's a number of strong names on there.
Perfect, Jonathan. So, well, thank you so very much. It's been a pleasure always to speak with you, and I look forward to, you know, your continuing coverage of the Papa John saga. So, thank you, Jonathan, and thank you all for dialing in. It's been a real pleasure to be with you this afternoon. So, have a great day.
Thank you.